at PDAC Mining Snaps 2016. I'm very happy to have two special guests with me today with Exploration Insights, Mr. Brent Cook and Joe Mazumdar. Thank you so much for being here today.
Thanks for the offer, son.
Thank you. So, as you know, Brent Cook, over 30 years in the sector as a geologist, as an investment advisor, and he's just had a lot of experience in this sector. His focus is Exploration Insights and smaller cap, junior cap resource stories, higher risk, but higher reward, and that's your focus. And we all know your background, so let's talk about Joe. You recently brought Joe to join Exploration Insights.
I've been pretty negative on the sector for the past 4 years, basically.
Right.
In November, I came around. I saw a lot of things in the global economy, currencies, interest rates, politics. Anyway, they told me that I think it's time to get back into precious metals.
Right.
And to me, the best place to start was probably not necessarily the junior explorers,
right,
but in the mid-tier mining companies or development companies that had, what I think were probably solid assets.
Right.
And I've been on a number of field trips with Joe. I've seen his work, and Joe is like the best I've come across that knows those sorts of things, as well as exploration. And so that's why I brought Joe on, is where we've expanded into the mid-tiers and done pretty well.
Going forward, the main themes that I've noticed myself is that we've seen, mining companies, with their production increases, less investment in exploration in the ground. Albeit we've seen some improvement in all-in sustaining costs as well. So what does this all mean at this point in time? What does this mean in the sector? What are we going through?
Well, what we have had is, we've had a cycle. The cycle has brought a lot of ounces on to the market, but not necessarily, let's say, accretive or ounces that would generate any free cash flow. And that's what we're feeling, the hangover of the vagrancies over the last 5 years.
Right.
Of trying to grow for growth's sake.
Okay.
And so now we're on the other side, finding out that, hey, maybe we'd be a bit more conservative on our reserve prices. Maybe we just tout the stuff that we can actually make money off of, and we peel everything back. So now we see a lot of impairments, which are sort of the pills you have to take right now to make sure you can live through the next few years. And so in a time where we could see the mid-tiers grow and actually show some accretive growth, organic growth, like what we've seen with Lakeshore Gold and some others. We've seen the Gold Corps and the Barracks and some other companies basically start tailoring down their production profile, which is a good thing, because in the end, once you tailor it down below a certain level, maybe you could show growth, but more importantly, you want to show return on those ounces, and that's what they're demanding. The investors are demanding that. They might change your tune later, but right now they're demanding that. And it's very hard to move an oil tanker.
Yes.
It takes a little while.
Yep.
The mid-tiers and the smaller companies could do it quicker.
Right.
And what we like is the disclosure on the smaller companies, and the mid-tiers is much better on the bigger companies. Because there's a lot of things that we'd like to know that we don't have access to.
Right.
And the field trips that we tend to do with the mid-tiers and the smaller companies, we could do by ourselves anytime we want. There's a lot of flexibility. It's much harder to do. And I've worked for Newmont, I've worked for Phelps Dodge. I know what hassles there are in trying to organize anything.
So what do you look for as an investor in this, sustainable, we hope this rebound is going to be a good long-term one, but what do we look for?
Well, there's many things to look at, and that shouldn't change based on what's happening in the background.
Right.
Whether the market's going up or down or sideways, how good's the management team?
Right.
Do they have any relevant experience doing what they're doing? How are they good, geopolitically? Do they know what they're getting themselves into?
Right.
And do they have access to funds? Do they know anything about capital structure? Can they put this thing into production? Or are they just, like the difference is those guys, like in the development world, the difference is between the guys that are staging something to sell and will never live in the house to the guys that want to live in the house. It's a completely different technical report. It's a completely different conversation. What we're really interested in, because of the lack of M&A that we've seen, is the guys that could get to the end zone and not the guys that are kicking the 50-yard field goals.
That's great. Okay. Interesting. So let's add another point here. I mean, I mentioned about lowered exploration investment over these last several years. Now, on top of that, over the last week, we saw a lot of the major mining companies revise their reserve estimates. So just adding on Joe's point on what he said earlier, how does this affect the future development of more ounces in this industry?
Well, what we're really seeing is rollover in production overall. The mine production is rolling over right now. I don't see that coming back. The issue they've got, really, in this whole industry, there's just not enough quality deposits that were formed. Yeah, it's fundamentally, there are not enough quality deposits out there to fill the needs of this industry, which is 1,300 juniors, and miners, and engineers, and that. So, and even when you do find an economic deposit, you're looking at 10 to 20 years before you put that in production.
That's correct.
So the production's rolling over.
And dealing with several variables at that point. It's political,
So
cultural.
It's going to get tight. It's going to get real tight for quality deposits, and that's where we're going to have fun.
Interesting. Yeah. Well, I can tell by your grin. You're obviously having fun right now.
We're always fun is number one.
Yes, that's right. So let's talk about M&A then. We've seen some M&A over the last couple of years. Just this past weekend before PDAC, we saw Endeavour do a transaction there with True Gold. That's correct. Primarily all these M&A deals are primarily all just cash deals. All share deals. So we haven't seen much of a component to cash back in last several years. So can we expect more M&A, and will the term structure maybe change, or does that depend on what other variables?
Well, that's a good point. It's like what we make a point in this talk I did this morning about not just getting funded, it's what does the capital structure look like, and this is not only getting taken over, what do they actually pay?
Yeah.
Absolutely. So, with the Endeavour True Gold transaction, what you do note is that it was an all-share transaction, but Tahoe was an all-share transaction as well. Mm-hmm. But Tahoe's got a really good asset in Escobar, so the Lakeshore guys get a bit of that. But Endeavour's always been a marginal producer, and they're very levered, and in this gold price environment, going from 1060 to 1250, they've done very well, as has True Gold. But capital structure-wise, True Gold had to do a stream, so that suggests the due diligence for me on the asset may not be as good as maybe a Rocks Gold in the same place that actually did debt.
Yeah.
Okay, so the asset might be a bit shaky, but these guys are willing to take it, but maybe they know something.
Right, absolutely.
Or whatever. But what we are not going to see is a lot of the majors going feet first into a big transaction because nobody's asking them to grow.
Right.
What we should see is on the development side, these assets, when the market changes, it's not just about growing, it's actually replacing the assets you have already that don't make any sense.
Right. Yeah.
It's just about basically running to stand still with another asset. And can you make it accretive?
Yeah.
Nobody is going to like a transaction that they don't believe is accretive, and I think a lot of people are scared of it.
Right.
So they won't buy just to buy because nobody's asking them to grow.
Right.
They're asking for a return.
It's interesting.
If that paradigm changes, things will change.
Things will change, for the better. Okay, so let's talk about this recent uptick in the gold price. It was around 1,100 or so. Now it's up to 12. It reached 1,270 actually on Friday. This recent uptick. So, given this confidence in the market and the metals market, what are the very first indicators for you that you look at that hey, I think we're back. The mining sector is back.
I think one that we directly know is subscribership to our letter.
Oh, interesting.
It's been picking up very steadily since December. February was a really good month, so we're getting a lot more subscribers coming in. To me, that's a real indication. We also look at the gold ETFs. That's getting a big bunch of money thrown into it. So we're starting to see investors.
The XAU and the Huey index even had that's been on a 30% tear since the beginning of the year.
And I don't think it's nut jobs coming into this right now. I think it's real investors who are recognizing that the markets are turning, major markets are turning. You're getting 0 to negative interest rates on money, and gold is actually a pretty smart thing to be owning right now.
Yeah, absolutely.
So it's different. I shouldn't say that. I think let me say this. To me, it feels like we're in this. There's some fundamental reasons why the precious metal prices, particularly gold, will do well going forward.
And if Trump becomes president, it's going to 2,000.
That would be very interesting. Yeah, absolutely. I say 5,000.
I'm moving here.
Actually, that's interesting you mentioned that, because as soon as I think it was the last debate, post the last debate when he was winning a few states here, there's been an uptick in Google search ratings for moving to Canada. So that was very interesting. So yeah,
you guys might want to build a wall.
Yeah, exactly. Yeah.
I'll just add
at least the fence around the house.
One more
but
thing to Brent's comment on long term. The other thing is, if you revert back to the fundamental thing that Brent mentioned before about the production profiles, so now you've got people buying gold for speculative reasons because, hey, we could have potential. We got negative interest rates in a lot of the world. We're not really sure what's happening with the U.S. economy, but it's the only light out there. But the U.S. dollar has grown, remarkably since June last year, but now we're hitting the slope where the growth is slowing down.
Right.
Still, a lot of these resource currencies are weak.
Yes.
But maybe it's going to turn the corner, but maybe it's just flattened.
Yeah.
Okay, so how much more damage can the U.S. dollar do on gold? It's limited. And also, the equity markets don't present an opportunity to say, if I'm risk on, I'll just go straight there. So I'm not risk on for the equity markets.
Right.
And then the whole thing is, if you think of money as a river, it's got to go somewhere. And gold is sort of like the proxy for under the mattress.
Yeah. Exactly.
And it's even a better under the mattress play if you've got negative interest rates.
Right, exactly, yeah.
Then importantly for us, what we need to see is the beta on the stocks.
Right.
So in 2011 when we saw gold, hit 1960, we saw the gold betas going down because nobody wanted the gold stocks because they thought they were overvalued.
Right.
But now we're going into a market where the gold price is going up, but the companies aren't overvalued. They're undervalued.
They're undervalued, yeah.
And then there's a fundamental under that the gold production's flattening.
Right.
And as Brent pointed out, it's 5 to 10 years or plus before you can turn that ship around.
Exactly, yeah.
So you've got long-term fundamental support.
Yeah, that's true.
You've got a bit of the wingnut support, but also on the gold side, it's been down a long time, and if people can get comfortable with a 1250, 1300 base, then a lot of things look a lot better.
Yeah. Well, then let's now switch gears, because you had a very interesting talk this morning, and and it was talking about shareholder structure. Now, as my experience being in this sector, as being a junior, you've seen a lot of companies who have to issue new shares to raise money. It's the essence of this market. It's just the essence of survival at the end of the day, and you're getting diluted share structure. So, one question is for a lot of investors is they're looking at companies now when the major rebound comes. Is that the new norm now of these diluted share structures?
Well, one thing everyone's got to remember is dilution is a numerator and a denominator.
Right.
People tend to focus in on the denominator.
Right.
But you could sell a stream, not issue any shares, and still be highly diluted.
Right.
And have no leverage.
That's right. Yeah.
So you've got to look at the capital structure. My talk is actually about the capital structure to fund the company.
Okay.
And then looking at it, the tea leaves issue, looking at it now to see how they funded it, to see if you could have seen the fatal flaws. So these companies were all funded in a period of very high financing risk, but still some of them failed. So we know why they failed, but is there something that we could have seen by the funding structure, like, hey, they couldn't issue any debt? Why is that? Is debt a very high level of due diligence? Well, it tends to be because these guys want the cash.
Right.
And if the project doesn't work, they can't pay me back.
Right.
Yeah. I don't care about the share price, but they got to pay me back.
That's right. Yeah.
And they got to pay me back at a certain gold price. And if I see that the company cannot deliver at 1,000 or 1,100, I'm not going to give you any money.
Right.
And so what we noticed was when the debt structure was really low or excessively high, over 80%, those companies tended to fail. And then we saw the ones with streaming being not the same kind of level as due diligence as a debt. So if you had a high proportion of a capital structure run by streaming, and you didn't trust the streaming company, and you didn't think they did very good due diligence, it's not going to say anything good about the asset. So don't feel comfortable that they got funded.
Right.
And it's going ahead.
Right.
Back away.
Yeah. Interesting. Oh, very valid points. Well, just to, I guess, end off just one more question, then we can get your last thoughts on how we proceed forward in 2016 and 2017. Joe, you made a very good point as part of your At the Bar series that you do with Make Your Fall. You've done that for Silver for a few years now. It's very interesting. You bring up a lot of good, interesting topics that you have a lot of very interesting guests as well. Was when you mentioned about when you worked a few years ago and you talked about about GARP. Can you just go into that and how that has changed?
Okay, so when I worked at the big mining company, gold mining company, they basically we had a review of all the investors, and I read through everything every investor said in terms of that company, what their investment thesis was. And GARP was a big one, growth at reasonable price. But I must say, one of them said, and this was funny, well, I'm saying it's funny, you can laugh if you need to, but that I don't see masochism here. That was his comment. But the point that I want to make is that growth at reasonable price was never reasonable. So gold companies, when I joined from Phelps Dodge, which was a copper company, to a gold company, at the copper company it was about cost, it was about safety. Every day, drum it into your head, safety, cost, safety, get this thing down, get this thing to zero. You know? And then when I went to a gold company, it was all about production. And it was all about that $1 of NPV. You know, where are you going to squeeze it from? It was never about return. And now the religion is the return. And that's a totally different focus and a different way of running your business. And the way the investors have changed, yes, but the question is how long will that last when gold goes to 50?
Correct. Are you at the behest of shareholders again to just, produce more, whatever
and so,
it may be?
So it's not always the companies that are driving the bus. It could be the investors that are driving them over the cliff.
That's right. And we've kind of seen that. So I guess to end off, any last points that Brent, you want to mention going forward 2016 that investors should really?
Well, I think there's a series that I've put up on the website called "What Was It Like, Dad?" which kind of goes through the last bust, the 1997 to 2002, what it was like, how we came out of it. And I think it's worth your viewers reading this to get a feel for where I think we are again. That's free on the website.
Excellent. Okay, well, thanks, Brent. Thanks, Joe. I really, really appreciate you coming down and sharing your insights, exploration insights. So that's explorationinsights.com. If you want more information, I'll put all the details on the bottom of this video here, and you can contact Joe or Brent directly and get some more information on the sector, as well as check out the At the Bar series. Thanks, Brent. Thanks, Joe.
Great. Thank you.
All right, great.
Cheers.